My channel Quest for Knowledge. Even if you have not studied for the whole year, even if you have not prepared yourself for from the previous month, then also by just following this video, you're going to get more than 60 marks. Okay, this is utility analysis expresses utility in ranks, ordinal ranks. Always cardinal means it is measurable, okay, numbers, but ordinal it is ranks. Cobb-Dollar's production function is equals to quantity is equals to quantity of alpha and quantity of beta. So this is the formula. Q is equal to x1a x2b. A bookseller sells 40 books at the price of 20 each. The total revenue of the seller, what is the revenue? P into Q is the formula. So 40 into 220 is equals to 800. RBI does not directly deal with general public. Easy availability of credit encourages investment. Find the total cost where TFC is 200, TVC is 225. So what is the formula? TFC plus TVC. Okay, so why am I writing this? So that whatever the changes might be here, but you should know the concept and write accordingly. Okay, so the answer is 425. Please don't become over smart. Nowadays we are so used to everything instant use of mobile and all of that. We are not as sharp as we think. So please make sure you are using calculator. Okay, even for the silliest of the calculation, very minor number also is there, but use it calculation. We can't take the chance as it is your public exam. Okay, the firm profit is denoted by pi r. All the laborers who are ready to work will find employment and all the factories will be working at their full capacity. This school of thought is classical thought. The point where x aunt aggregate demand is equal with x aunt aggregate supply is called as equilibrium. The market in which national currencies are traded is called foreign exchange market. So national currencies are traded, surely it will be foreign exchange market, which is the example of microeconomics. It is consumer behavior. Next, when TU is constant, MU becomes 0, and when MU becomes negative, TU starts to fall. So this is the theory of law of diminishing marginal utility. Once you know the concept, it is very easy for us to understand it. As a result of increase in the number of firms, there is an increase in supply. The supply curve shift rightward. Whenever there is increase in the supply, the supply curve will shift rightward. Okay. Net national product at factor cost is also known as national income. So please always mind that you have to understand this. NNP at FC is equals to national income. You have to understand this one and please keep it in your mind. When excess demand, the available output under conditions of high employment level, this may give rise to inflation. Yes, price will increase when there is excess of demand and all the employment, okay, all are working under high employment. Then what will happen? Inflation will rise. Now let's move on to the fill up. In reality, all economies are mixed. Want satisfying capacity of a commodity is called utility. What is utility? Want satisfying capacity of a commodity is called utility. Everything has its own punch dialogue. So this punch dialogue is want satisfying capacity of a commodity is called as utility. Okay. Dash is determined at the point where the demand for labor and supply for labor curves intersect. So the supply of the labor, demand of the labor, here it meets. This is the quantity of the wages to be appointed and this is the wage. The net contribution made by the firm is called value added. So this is the contribution made by the firm is called as value added. An increase is the price of foreign currency in terms of domestic currency is called devaluation. In the foreign currency price is increasing and domestic currency price is decreasing, then it is the devaluation of our currency and revaluation of foreign currency. Okay, and sometimes if foreign currency is falling and domestic currency price is increasing, then it is revaluation of our country and devaluation of their country. Okay. Next, the demand for a good moves in the opposite direction of its price. Always the demand and price will have opposite direction. They have inverse relationship. Okay. Unit tax is a tax that government imposes per unit sale of output. Unit tax is a tax which government imposes per unit sale of output. The principal motive of holding money is to carry out transaction. Okay, buying and selling, exchanging. So that is the reason why we hold the money. Size of multiplier depend on the value of investment. Financial year runs from 1st April to 31st of March in India. Dash is the set of all possible combination of two inputs that yield the same maximum level of opportunity cost of some activity is the gain forgone from the second best activity. What is the punch dialogue of opportunity cost? The next best alternative forgone. Macro has a deep roots in micro. Both are interdependent, interrelated, interconnected. Dash issues coins in India. Government issues coins in India. Errors and omissions are third element of balance of payment. Okay, time to move for all the matchup of all the three model paper here. Complementary goods, pen and ink, PIR, it is TR minus TC. Whatever is remaining is our profit. Domestic services are non-monetary services. Aggregate demand for final goods, the formula is autonomous consumption plus autonomous investment plus induced consumption. Managed floating is also called as dirty floating. Linear demand curve formula is D into P is equals to A minus BP. Marginal productivity of labor, TPL minus TPL minus 1. Perfect competition, perfect information. Liabilities are deposits. Excess demand lead to rise in price. Then what will happen? Excess supply lead to fall in price. Okay, like that you have to do the smart work. Positive economics, function of mechanism. Normative economics, evaluation of the function of mechanism. Unitary elastic, ED is equals to 1. Inelastic, ED is equals to 0. Positively elastic, ED is greater than 1. Or infinity. Relatively elastic, ED greater than 1. Positively elastic, ED is equal to infinity. Possibility of supernormal profit will lead to attract new firms so that new firms will start to arrive in the market. Inventory, stock. SLR, statutory liquidity ratio. Statutory liquidity ratio. By this we are done with the matchup of all the three model paper. Now let's move on to answer the following. Answer in one word. State the law that explains short run production analysis. Short run, law of variable proportion. So there is a chances of asking one more question, which is state the law that explains long run production analysis. Then what you will write? It is the law of return to scale. So for short run, law of variable proportion works. For long run, law of return to scale works. Okay. Next, what is supply? When the producer is willing to sell is called as supply. Then you will get a question, what is demand? Then when the consumer is willing to buy a product at a different price is called as demand. So you should be doing the smart work. What is supply? The quantity of commodity which the producer is willing to sell at a different price during a period of time is called as supply. Name the well-known work of Adam Smith, The Wealth of Nations. What is velocity of circulation of money? It is the speed at which the money changes hands to hands in an economy in a given period of time is called as velocity of circulation of money. After then, state the meaning of public production. Production of goods and services by the government or public sector is called as public production when it is done for the public. If the demand curve of two consumers is equals to D1P 20 minus 2P and D2P 25 minus P, find market demand. Market demand formula is equals to D1 plus D2. So you just need to add. So DP, okay, demand of the market. So 20 plus 25, 45. 2 plus 1 more P, 3P. That's it. Just add and write the answer, which is 45 minus 3P. Give supernormal profit when total revenue is greater than total cost. Whatever you earn something extra more than the normal profit is called as supernormal profit. Give any one example of non-tax payment. Fees or penalty are considered as non-tax payment. After them, mention any one fiscal variable which influence aggregate demand. It is income tax. Okay. What do you mean by open economy? Please write the word correct. An economy open to trade with other country or the interaction with the global economy is called as open economy. Suppose to a consumer 2 oranges gives 22 units of total utility and 3 oranges gives 25 units of total utility. Calculate MU. What is the formula of MU? TUN minus TUN minus 1. So when 2 is giving 22 utility and 3 is giving 25, then the formula is 25 minus 22, 3. The MU is 3. Name the return to scale when output increases by 10%, input increases by 10%. So both is in constant. So the answer is constant return to scale. Define marginal revenue. The additional revenue earned by selling additional output is called as marginal revenue. The formula is total revenue N minus total revenue N minus 1. Give the meaning of consumer durable. Durables means which will be lasting for longer period of time. So car, TV, etc. will come under durable. What is appreciation of domestic country? It means increase in domestic currency is called as revaluation. Decrease in any country is called as devaluation. What do you now? We'll start with the 2 marks. What do you mean by mixed economy? A mixed economy is an economic system where both government and private sector operate. Example, India. What is monotonic preference? A consumer always prefers more good than less good, which gives higher satisfaction. Example, rupees 5 he's getting 3 bananas, or rupees 5 she's getting 4 banana. Then what she will prefer more? She will prefer whichever is offering her more of the commodity. So the consumer will prefer only those commodity which is more than by preferring the commodity which is less. Give the meaning of short run and long run concept. Short run is a period in which one fixed input and one variable input will be contributing in the production. Long run is a period in which all the input will be variable. Law of proportion, which handles the production analysis. Law of return to scale, which handles the long run production analysis. State the conditions needed for profit maximization from a firm under perfect competition. So there are 3 conditions which the firm has to fulfill. One is marginal cost should be equal to marginal revenue. After then, marginal cost must be non-decreasing at output. Third one is price should be greater than average variable cost in the long run, and price should be greater than average cost in the long run. This is long run and this is short run. Write the meaning of opportunity cost. The next best alternative foregone is called as opportunity cost. Mr. A invests 5,000 rupees in family business and he foregoes the next best alternative of reaping profit from shares by investing in the share market. State the 3 methods of measuring GDP. So there are 3 methods of measuring GDP: value added method, expenditure method, and product method. What is transfer payment? Transfer payment made without receiving any goods or service in return. That is pension. If MPC is equals to 0.8, calculate MPS and investment multiplier. So what is the formula for MPS? Marginal propensity to save. 1 minus 1 is, if 1 is your income, then it is considered that 0.8 is your consumption. Okay, then whatever remaining is your saving. So this is MPS. Now it is asking what is investment multiplier. The formula is 1 divided by, that is income, 1 divided by MPS. So 1 divided by MPS 0.2 is equals to 5. The more the MPC, the more the investment multiplier will be. Okay. State the difference between public good and private good. Public goods, which is provided by the government, like street light, and it is used by all and there is no restriction. Private goods are provided by the private firm, example food, cloth, etc., and it is used by the individual by paying for it. Borrowings are considered as capital receipts. Why? Borrowing increases liability of government. The borrowings are not regular income of government. It has to be repaid. So it is considered as capital receipt. List out the basic economic system. Economic activity: production, distribution, and consumption. Mention 2 approaches which explain consumer behavior: cardinal utility approach, ordinal utility approach. What are the long run cost? Long run cost incurs when all the factor of productions are variable. Mention the 2 determinants of a firm: supply curve, price of commodity, and cost of production. Give the meaning of price elasticity of supply and write its formula. The responsiveness of quantity supplied to a change in price is called as price elasticity of supply. The formula is percentage change in quantity supplied divided by percentage change in price. Give the meaning of intermediate goods with an example. Goods used as an input for producing other goods. Cotton used to produce cloth, wheat used to produce bread is all example of intermediate good. This is real GDP inflator, 400 rupee, and nominal GDP 450. Calculate GDP. GDP deflator formula is nominal divided by real into 100. 450 divided by 400 into 100. The answer is 112.5. Okay, let's move on. What are the 2 components of consumption function? Autonomous consumption, induced consumption. Write any 2 objectives of government budget: economic growth, reduction of income inequality. Mention any 2 direct and indirect taxes of central government. Direct are income and corporate tax. Indirect are GST and custom duty. What is production possibility frontier? The maximum possible combination of 2 goods that can be produced with given resources and technology is called as production possibility frontier. List out the factor that determines optimal choice of a consumer. So, price of good. So, list out the factor that determines optimal choice of a consumer: consumer income, price of goods, and taste and preference. Name any 2 short-run cost. Total fixed cost, total variable cost. Give the meaning of shutdown point. Whenever the price is equal to average variable cost, or whenever it touches to the minimum of AVC, is called as shutdown point. Find the market supply. Again, we have to add. Okay, what we are doing here, this is the market supply. Supply 1, supply 2 is equals to market supply. Like how D1 plus D2 is equal to market demand, similarly S1 plus S2 is equal to market supply. So P, 1P, 2P, 2P. Okay, 15 plus 20, 35. What are the 4 factors of production and their reward? Factor of productions are land, labor, capital and organization, and rewards are rent, wages, interest and profit. Every land will fetch rent, every labor will get wages, every capital will get interest, and every organization will earn profit. What is meant by accumulation and decumulation of inventory? When production is greater than sales, stocks gets added is called as accumulation. When sales are greater than production, stocks get deducted is called as decumulation. Give the meaning of MPS and APS. Marginal propensity to save and average propensity to save. The formula for marginal propensity to save is change in saving divided by change in income. Average propensity to save is the ratio of total saving to total income. Mention the components of planned revenue expenditure like grants, subsidies, interest payments, government consumption expenditure. All of this will come under planned revenue expenditure. Why does proportional income tax act as an automatic stabilizer? When income rises during inflation, tax increases. When income falls during deflation, tax increases there, here tax decreases. So proportional income tax manages automatically, so it is called as income stabilizer. Okay, so by this we are done with MCQ, fill up, and 1 mark and 2 marks. In the next video we will be discussing 4 marks, 6 marks and POQ. So stay tuned and keep watching. We are going to start with the 4 marks. It's very, very important because of chapter wise we are going to prepare. So it is going to be really easy. Along with that, it is really going to help you to get good marks. Write about centrally planned economy. So most of our students will get confused between what is the central problem of an economy and centrally planned economy. So centrally planned economy is an economic system. What are the central problem of an economy? Means it is asking you the question, what are the main problem of an economy? It means what you need to answer, what to produce, how to produce and whom to produce. So please don't get confused over there. Okay. Right, centrally planned economy. Centrally planned economy is called as command economy or socialistic economy. All the major decisions of economic activities such as what to produce, how to produce, whom to produce is taken by the government. Government play a major role in this economy as it is government one, so it is service oriented and welfare oriented, and it is not at all profit oriented. Countries which follow centrally planned economy is North Korea, Cuba and Vietnam. Now the next question is, when we have understood about centrally planned economy, now the opposite of centrally planned economy is market economy. So what is market economy? It is called as private economy, it is called as capitalistic economy, it is also called as laissez-faire economy. All the major decisions here are taken by the private enterprises. So prices are also set by the mechanism of demand and supply. As per the demand, as per the supply, the price is being set. Profit is the main motive of the market economy. Government plays a very minimum role here in this economy, may be limited to defense and law and order. USA, Japan, Australia considered as the best example to describe about market economy. Now the third question, what are the central problem of an economy? As you see here, what to produce, how to produce, whom to produce. What to produce, in what quantity, describe about the problem of choice. How to produce, resources to be allotted, how much to be produced on cotton, cloth, and how much to produce on food and like that. How to produce, discuss about the problem of technology. Okay, whether to follow modern or traditional method, and to be capital intensive or labor intensive. Whom to produce, discuss about the problem of distribution, which category of consumer you are going to make the product for the size of income, their taste and preference, etc. The above are the central problem of an economy. What is production possibility frontier? The possible production can be done of two commodities which can be done with the available resources and technology is called as production possibility frontier. The set of combination of two commodity which can be produced with the available resources and technology is called as production possibility frontier. So the PPC is always concave. Why? Because in order to get one thing maximum, the other has to go for minimum. If they are producing A to the maximum, then the other 0. And if they are producing E to the maximum, then the other goes for 0. So in order to produce one thing to the maximum, the other has to go to the minimum. This is called as opportunity cost. What is opportunity cost? The next best alternative foregone. Below the PPC curve, resources are underutilized. As you can see in the diagram, below this we have not used the resources correctly, and it is impossible to use the resources which is out of this line. So this line shows the efficient utilization of resources. Okay. PPC curve shows the efficiency of resources utilized. Now we'll understand what is simple economy, explained with the help of a farmer, weaver and teacher. As every individual, you need to keep this in mind, every individual is busy with the production of goods and services. But every individual cannot produce everything they require or need. But they can produce something with their available resources and technology. So let's understand with the help of an example. A farmer has land, axe, ox. With the available resources, he produces rice. The rice, some portion he keep it with himself, the rest he exchange it in the society in order to meet other needs. Okay, the weaver may have yarn. Out of that, he may produce a cloth, and some he may keep it for himself, and some portion he will exchange it in the society in order to meet other needs. Teacher will use skill to earn salary and meet her other needs. So she might not be producing anything, but she will use her skill in order to get the salary. The above are the examples of simple economy. After then, we are moving towards the second chapter now. Consider a market where there are two consumers and the demand for the goods at different prices. So this is price given. This is demand of one individual, demand of second individual. Now it is asking you about the market demand. So what is the formula? Market demand is equals to D1 plus D2. Just add and write it. So this is the demand of one individual and this is the demand of second individual. By adding that, you will get the market demand. 9 plus 19, 28. 8 plus 17, 25. 7 plus 15, 22. 6 plus 13, 19. 5 plus 11, 16. 4 plus 9, 13. 3 plus 7, 10. Difference between substitute and complementary good. Now, what is meant by substitute? Which can be replaced. Tea or coffee. You cannot consume it both. So, when price of one good increases, demand for the other increases. So, they have positive relationship in demand, which is called as positive cross elasticity. Complementary, which can be used together, like bread and jam, petrol and bike. One completes the other. When price of one goods increases, the demand for the other decreases. So, negative relationship with demand, and it is called as negative cross elasticity. Okay. Next, suppose okay, and P1 is equals to 8. At the price increases to rupees 10, it means P2 is equals to 10. She reduces to 16. So Q2 is equals to 16. Find price elasticity of demand. Price elasticity of demand formula is percentage change in quantity demanded divided by percentage change in price. There are many formulas which you can follow, but this one is the easiest one, I believe. So I follow this one. So in order to find percentage change in QD, the formula is Q2 minus Q1 divided by Q1. So here Q2 is equals to 16 minus 20 divided by 20 into 100. Okay. So 16 minus 20 minus 4 divided by 20 is equals to into 100 is equals to minus 20. Okay. Now, percentage change in QP for that formula is P2 minus P1 divided by P1. So, what is P2? 10 minus 8 divided by 8 into 100. So, 2 divided by 10 minus 8. 2 divided by 8 into 100 is equals to 25. So, now, percentage change in QD divided by percentage change in QP is equals to minus 20 divided by 25. Minus 20 divided by 25, we are getting the answer which is minus 0.8. When it is in minus, it is called as inelastic. When you are getting the answer in minus, it is considered as inelastic. Inelastic. I hope you are able to understand. Q1 20, Q2 16, P1 is equals to 8, P2 is equals to 10. So percentage change in QD divided by percentage change in price. In order to find out the change in QD, formula is Q2 minus Q1 divided by Q1. So the difference, what is the difference? Minus 4 is the difference. Minus 4 divided by 20. So the answer is again into 100. Minus 4 divided by, here you can see minus 20 divided by 25, we are getting minus 0.8, which is inelastic. Next question, write about shutdown point, normal point, break-even point. Shutdown point when P is equal to the minimum of AVC is called as shutdown point. Below this point, the firm will not produce any output as it will be facing heavy losses. It covers only variable cost. P is equals to AVC. It is covering only variable cost. So the TFC is loss and the price is less than 0. Price if get less than minimum of AVC, then 0 production. What is normal point? Normal point when TR is equal to TC. No profit, no loss. Only the cost is covered. Average revenue is equal to average cost. In this case, the firm continues production as the cost of production is covered but nothing earned extra. Now, what is break-even point? Break-even point is called where there is no profit, neither loss. In this situation, TR is equal to TC. Cost is covered and firm will continue production normally. Now, here again one interesting question. Assume there are 100 balls are produced by the firm in the market price of rupees 5. When the price ball rises to rupees 15, firm produces 1000 supply. Find the price elasticity of supply. The same question, students, but the same that here previously we understood about demand. Here we will be finding about the supply. Okay. As you can see here, the question is P1 is equals to 5, Q1 is equals to 100. Okay, P2 is equals to 15 and Q2 is equals to 1000. When the price was 5, how much the quantity produced? 100. When the price increased to 15, the quantity produced is 1000. Now you have to find price elasticity of supply. The same formula, percentage change in quantity supply divided by percentage change in price. So in order to find out the percentage change in quantity supply, the formula will be Q2 minus Q1 divided by Q1 into 100. So that first Q2 is equals to 1000 divided by minus 100 divided by 100 into 100. What do we get? 900. This will get cancelled, so 900. And then percentage change in price. So the formula, so the answer will be P2 minus P1 divided by P1 into 100. So what is P2 here? 15 minus 5 divided by 5 into 100. So our answer is 15 minus 5 divided by 5 into 100 is equals to 200. So 900 divided by 200 is equals to 900 divided by 200 is equals to 4.5. It means the supply is elastic because it is greater than 1. The supply is elastic. Now the next question is determinants of firm supply. First is technological progress. When the firm adapts new technology, output increases, so as the supply increases. If the raw material price increases, what will happen? Your profit will get reduced. If your profit is decreasing, then your output you will produce less. When you are producing the output less, then you will supply less. And it is vice versa. Vice versa means, suppose if the input prices declines, then what will happen? It will increase your profit. Then when it is increasing your profit, you will produce more. When you produce more, you will supply more. Unit tax. If the government reduces the tax, supply will increase. If the increases the tax, supply will decrease. Goal of the firm. If the firm goal is profit maximization, it will supply more. If the firm goal is risk minimization, then it will supply less. Nature of the market. If it is monopoly, they have the they can easily restrict the supply in order to increase the price, in order to increase the demand. If it is perfect competition, they don't have any chance to increase or restrict the supply. Next, what is the implication of free entry and exit of market equilibrium? So, in the perfect competition, this is the price which is equal to cost. Price is equal to cost and price is equal to minimum of AC, that is average cost. And wherever the demand curve is intersecting, that is the quantity produced and that is the price. Okay. So, here what you need to write is that in the long run, equilibrium price will always be equal to minimum of average cost because of free entry and exit of the firm in perfect competition. In perfect competition, majority of them enter and they are free to exit also from the competition. So, all firms will be earning zero profit or normal profit. So, E is attained wherever the price is intersecting with the demand and price is very minimum to the average cost and E is the supply of the quantity. Okay. Now here one more question. Consider the cotton market. Consider the cotton market 30 minus P. Assume the market consists of identical firm in which supply of single firm is. Here we are getting only the single firm supply. This is the total quantity demanded of firms, all firms. This is the single firm. Single firm supply is equals to Q is equals to 20 plus P and the price is equals to 30. Okay. Calculate equilibrium of firms. It means how many firms are there. So how many firms are there? We don't know. Okay. We have to find the number of firms. So first thing what we are going to do is QD is equals to 430 minus P is given which is 30. Then QD of all the firms is the total number of firms is 400. Okay, we know what is the QD, but we don't know what is QS, and we have got only the supply of a single firm. So Q is equals to 20 plus P. This is QS. So 20 plus 30, QS is equals to 50. So quantity supply of single firm is equals to 50. So in order to find the number of firms, what we need to do? 400 divided by 50 is equals to 8. It means there are 8 number of firms. And you can also find out the quantity supply of all firms, which is QS is equals to 50 into 8 is equals to 400. So QS is equals to 400. because QD is also 400, QS is also 400. Our answers is correct. It means there are number of 8 firms are there. Okay. Explain price ceiling and price flooring. Explain price ceiling and price flooring. What is meant by price ceiling? When the government set upper limit. Ceiling means it is up, so it is upper limit, which is set by the government. Why it is set? It is majorly imposed for the necessary items like wheat, rice, kerosene, which consumer will demand more and supply is less. As the price set is less than the equilibrium price, so the intention of the government was to help the consumer to afford for the good, but they will end up creating more demand. So what the interference of the government will lead to excess of demand. This is called as price flooring. Please make sure you are going to draw good graph. Sorry, the diagram should be proper. So this is the supply, this is the demand. Okay, so this is the equilibrium price actually, but the government will set the upper limit, which is the maximum you have to. For example, this is 50, but rupees 50 suppose, but the government is setting the maximum price you have to set is only 30. So that what will happen, when the consumers are ready to pay 50, the government is interfering and forcing them to pay only the maximum which has to be paid is 30. So what will happen, demand will be more and supply will be less. So this is the supply and this is the demand, but this is the actual quantity which has to be supplied or demanded. But due to the interference of the government, which has led for more excess of demand, the main intention of the government was to make the product affordable for all, but it will end up making the more of demand for the same good. Similarly, what is price flooring? It is setting the lower limit. It is majorly used for agricultural product and wage. Okay, here you can see it is actually what will happen if they have set the minimum limit, but it is actually more than the equilibrium price. So that what will happen, more of supply and less of demand. Okay, here you can see the diagram. Make sure you're going to do it correctly. Okay, so this is the supply, this is the demand, and this is the equilibrium price, and this has to be the equilibrium price. But here the government has set the minimum limit, which is actually higher than the equilibrium price. So what happened here, the demand is less, but the supply is more, and there is a gap. So it is called as excess supply. Okay, the interference of the government has led to excess of demand here and excess of supply here. Right, discuss the role of government and household sector in both developed and developing countries. State government is a major sector of an economy. The role of government is to frame law, impose tax, spending money on building infrastructure, running school, college, hospitals. We denote the term state to government. The government main duty is to maintain law, order and justice. Household, it refers to single individual who take decision related to his consumption, or group of individual deciding the consumption or jointly determine. Household saves money, pay taxes, spend on goods and services, and they offer services as worker, and they earn from the firms, and they also can be the owners, and they can earn profit. So difference between micro and macro. It is concerned with the study of individual is called as micro. It is concerned with the study of aggregate. It is called as macro. It adopts partial equilibrium. It adopts aggregate equilibrium, general equilibrium. And it is called as slicing method approach. It is called as lumping approach. It is worm's eye. It is bird's eye. The theory like consumer behavior in the micro. The theory like income and employment in the macro. And it is like price theory. It is considered as income and employment theory. It is a narrow approach. It is a broad approach. It is like you look at a tree, and it is like you look at a forest. Emergence of macroeconomics. Macroeconomics, why did we start it as a separate branch? So it is only after John Maynard Keynes, who published his celebrated book, General Theory of Employment, Interest and Money in 1936. Before and all, the main dominant thinking in economics before Keynes was that laborer who are ready to work will find employment and all factories will be working at their full capacity, was the classical thought. But after the Great Depression 1929 and the years after then, witnessed a lot of unemployment in Europe, North America, and demand was less as there was a lot of unemployment. And then factories was also idle. Okay, thousands of workers were removed from the job. This made economists to think new way. So Keynes gave a direction with his book. Okay, because of that, macroeconomic was born. Legal definition of money. The total stock of money circulation among the public at a particular point of time is called as money supply. And how the money is being supplied, it is into 4. M1, M2, M3 and M4. M1 and M2 is considered as narrow money, which is liquidatable. M3 and M4 considered as broad money, which is least liquidatable. So M1 is nothing but the currency and demand deposit. Okay, and M2 is equals to M1 plus saving plus demand deposit of commercial bank. M1 plus time deposit of commercial bank. Time deposit means it is fixed deposit. Okay, so M3 is equals to M1 plus time deposit, which is nothing but fixed deposit. M4 is equals to M3 plus total deposit in the post office savings organization is considered as M1, M2, M3, M4. M1 currency plus DD, M2 M1 plus savings deposit in the commercial bank or with the post office, M3 M1 plus fixed deposit in the commercial bank, M4 M3 plus total deposit in post office saving. What is the speculative demand for money? People, along with using cash, people hold wealth in the form of property, gold, bond, shares, etc. The speculation demand for money refers to the demand for money that people hold as ideal cash balance to speculate future capital gains and profit. The speculative demand for money is oppositely related to the rate of interest. So that is why the formula is money speculative demand for money is equal to R max minus R divided by R minus R max. It was explained by Keynes. When interest rate high, bond price falls. When interest rate is less, bond price rise. So that is why people hold money to buy at right time. Whenever interest rate high, speculation demand for money decreases. Whenever the interest rate is low, speculative demand for money increases. This is the last 4 mark now. Functions of RBI. Issue the currency of the country. RBI is the main currency issuer. Okay, it is the only monetary authority which issues currency notes like 50, 10, 100, 20, 500, etc. Banker to the government. RBI acts as a banker, agent, advisor to the government. It receives and pays on behalf of government as well. Banker to bank. When there is nobody to help or give any financial assistance to the commercial bank, then RBI comes for the rescue. And it is also controlled and managed by RBI. And every bank has to maintain certain reserve with RBI. Lender of last resort. When commercial bank need source, the last source of financial assistance which they can get is from RBI. Controller of money supply. It maintains the money circulation of the country through open market operation, through reserves, etc. Custodian of foreign exchange. RBI maintains reserves such as gold, foreign exchange currency, etc. So these are the various functions of RBI. Now we'll start with 6 marks. So the first 6 marks is the law of diminishing marginal utility. It is formulated by Gaussen, popularized by Alfred Marshall. If consumer increases the consumption of any one commodity, keeping other thing constant, that marginal utility will decrease and total utility will increase. Assumptions: no gap, consumption must be continuous, utility is measure, other thing being equal, consumer is rational. After then you can go with this. For example, units 1, 2, 3, 4, 5, total utility, which is like increasing, coming to a saturation point and falling. Marginal utility decreasing. They both start with the same number, but this gradually starts to fall and then it becomes 0 and then it turns into negative. The same thing you have to put it on graph, which is the total utility increases, moves to a saturation point and fall. MU falls, turns 0 and becomes negative. The every consumption of commodity increase total utility, but the marginal utility diminishes. To utility increase moves to saturation point. When MU turns 0 and negative, that time, when MU turns 0, that time only the TU falls. Okay, and MU and TU was same in the beginning, but MU falls, becomes negative after turning 0. This theory is called as law of marginal utility. The punchline is the more and more you consume, the less and less you want to have it. Okay, this is one important 6 marks. The one more important 6 marks is features of indifference curve. So let's understand the features of indifference curve. Indifference curve slopes downward from left to right. The goods curve slopes downward from left to right. In order to have more quantity of goods, consumer has to give up the other quantity of goods. Higher indifference curve, higher level of satisfaction. As you can see, the goods X is increasing, the goods Y is remaining constant, but still the indifference curves are increasing, which means higher the level of indifference curve, higher the level of satisfaction. The two indifference curve never intersect each other. The two indifference curve never intersect each other. Intersecting can lead to conflicting result. So two indifference curve cannot intersect each other. IC curve cannot be positively sloped because it will give unrealistic and conflicting result. IC curve cannot be straight line because the marginal rate of substitution diminishes if it cannot be constant. IC cannot be concave. IC is convex and it cannot be concave as it is not feasible. After then, if IC cannot touch x-axis or y-axis. Yeah, it cannot touch neither y-axis neither x-axis. So that is all about the features of indifference curve. After then we have optimal choice of a consumer, which is very, very important. The budget set consists of all bundles that are available to the consumer. The consumer can choose consumption bundle from the budget set. It is the consumer indifference curve depicts the choice and priority of a consumer. The budget line shows the ability to pay. In order to achieve consumer equilibrium that maximizes utility, the indifference curve has to be combined with the budget line because budget line shows the affordability, indifference curve shows the desirability. It means the consumer should not only desire for it but also should have the ability to pay for it. Assumptions: income of consumer is given. Consumer is rational. Okay. Price and goods and services are constant. Consumer is aware of indifference curve. All goods are homogeneous and divisible. After then, you can see A is greater than B, B is greater than C, and A is greater than C, etc. Okay. These are 4 indifference curve, IC1, IC2 and IC3 and IC4. Budget line is also drawn. ABCD points are given. So D is not optimal, but because it is out of budget line, so it may give higher satisfaction, but the consumer may not be able to afford for it. And IC2 is the A. B is also not the optimal choice as it lies in IC1. Why will the consumer will go for lesser satisfaction when it can afford for better satisfaction? C is also not the optimal choice as it lies in IC1 only. A is the optimal choice of a consumer because indifference curve is tangential to budget line. It means the consumer can not only desire for it but also has the ability to pay for it. After then, here you can see the formula. Price of x divided by price of y. In order to get the marginal utility of x, you have to pay the price of x. In order to get the utility of y, you have to pay for y. This rule states that the willingness to substitute more x with mu y. In order to get more of this, you have to sacrifice this. Okay, and it is also equal. And you also should have the ability to pay for more of P1 in order to, and you have to leave more of the P2 in order to get more of the pay for more of the P1. Okay. After then, this one question is also there. Deriving a demand curve from indifference curve and budget constraint. So here you can see the individual consuming bananas and mangoes. Income is M, price is P1 and P2 respectively. And if you want to buy X1 quantity of bananas, then you have to pay P1. And if you want to buy X2 quantity of mangoes, then you have to pay P2. Okay. When the price starts to drop, the budget sin automatically increases. Okay. So if the price is dropping from P to P1, then it is giving you more opportunity to buy for more bananas. So your indifference curve increases. And when the price of banana decreases to P2, it gives you the budget sin expands. And then what happens? Your indifference curve increases. So you are able to buy more of bananas with the available income and you are able to get greater satisfaction from it. This is one of the important questions. The movement along with demand curve and shift in demand curve with the help of two diagrams. Shift in demand curve is that except a price, change in any other thing will lead to shift. So if by chance there is a change in consumer income, like what happens if there is a income of the consumer increases, the consumer will buy more of normal good. So the normal good demand will shift to rightward and the consumer will buy less of the inferior goods. So the inferior goods demand will shift towards the leftward. And suppose if the price of related goods, there is a change in the price of related goods, suppose complementary goods and normal goods, then what will happen? If the price of substitute is reduced, then what will happen? If the price of the price of substitute product increased, suppose you are selling tea, coffee price increased, then your demand for tea will increase. Okay, so it has positive relationship. Your tea demand will shift towards the rightward. And if it is complementary good, then what will happen? If the flight tickets are increasing, then tourism demand will go down. If flight ticket decreases, then tourism demand will go up. So what will happen? If tickets are increased, then the demand for the tourism will go towards the leftward. So that is the difference between substitute and complementary good. Okay. What is movement in demand curve? It will either move up or it will either move down. So that is called as movement in demand curve. Whenever the price is high, demand is less. Whenever the price is less, demand will be high. After then, explain the market demand with the help of a diagram. The market demand of a good at a particular price is the total demand of all consumers taken together. The market demand for a good can be derived from individual demand curve. So this is individual demand curve. This is individual demand curve. So adding together, you will get market demand. So this is also called as horizontal summation. Suppose the individual demanded this at a particular price, this quantity. When the price reduced, the same consumer demanded this much of quantity. And the second consumer demanded this much of quantity at a different price. And this much of price it has demanded for this much of quantity. By adding this and this, you will get the market demand. By adding this and this, you will get the market demand at various prices. So it is called as horizontal summation. What is price elasticity of demand? Demand for some goods are very responsive to price changes, while demand for certain others are not so responsive to price changes. So elasticity of demand is percentage change in quantity demanded divided by percentage change in price. Okay, so elasticity along a linear demand curve. Here you can see this is necessity products. Whatever be the price, the demand will remain the same. This is also for the necessary item only. Even if the price reduces, the demand will not increase much. Like salt, people will buy petrol, people will buy as per the necessity only, not more than that. They will not stock up. Unitary elastic for the discounted item. For example, for 100 if they were purchasing one, for 50 they will purchase the two. Anyhow it remain the same. Relatively elastic, it is for luxury item. Okay, any slight change in the gold price also the demand will increase. Positively elastic, the extremely volatile one. So we don't know, any change in price lead to either no demand or it will create demand to the infinity. So though that is all about the. So all this diagram we are going to put it in one diagram. So this is E is equal to 0. E is lesser than 1, which is relatively elastic. After then E is equals to 1, which is unitary elastic. After then E is greater than 1, which is Relatively elastic, E is equals to infinity, which is positively elastic. So all of this we are going to put it in one diagram, and then what we are going to write it, change in quantity divided by change in price is equals to minus B. Substituting value of change in quantity divided by change in P, what do we get? Elasticity of demand is equals to, because it is downward sloping, negatively sloped, no? So minus B, P divided by Q. So here we get the, when price is equal to 0, elasticity is also 0. When quantity is equal to 0, elasticity is equals to infinity. When P is equal to A by 2B, elasticity is equals to 1. So after then, important 6 marks we have is what is TP, AP and MP, and what are the shapes of TP, AP, MP we have. So here you can see the total product in the amount of one of the input, keeping all other input constant, it is increase in output. TP changes as labor increases. So TP is increasing after a certain point, TP falls. So this is the shape of TP. AP, the output per unit of input, AP is equal to TPL divided by L. AP increases after a certain point. AP falls due to the law of variable proportion. The shape is inverse U. So here you can see this is AP. What is MP? The change in output per unit of change in input. So whenever AP is increasing, MP will increase more than AP. Whenever AP is falling, MP will fall more than AP. So the shape of MP also is called as inverse U. It is due to the law of variable proportion. When AP rises, MP rises more than AP. When AP falls, MP falls more than AP. Conclusion in short run, the shape of AP and MP is inverse U due to law of variable proportion. Now we'll understand what is the law of variable proportion. It is also called as the law of diminishing marginal product. Assumption is that technology is constant. Technology is constant. One input is fixed, one input is variable. Factors of productions are not perfect substitute. The law of variable proportion explains the relationship between proportion of fixed and variable input of one hand and output on the other. In short period, firm wants to expand its production. It can do so by increasing the variable factor and keeping other things fixed. Until MP is positive, the output is positive. Once MP falls, output also falls. Here you can see till here it is always positive. Once the MP start to fall, everything will start to fall. The efficiency will go. And after then you have to give this diagram. TP, AP and MP. If we keep one input fixed and keeping other input to change, the proportion will change after a point and there will be crowded and MP will fall. Keeping one input fixed and changing the other input, initially MP will rise, after a certain point it will fall, is called as the law of variable proportion. So this is from the same third chapter continuation. You will get the question like labor 1, 2, 3, 4, 5 and you are going to get APL. You are not going to get TPL, you are going to get APL. Then what you need to do, see, most probably the formula for AP is equals to TP divided by L. Okay, so here AP is given. Okay, but TP is not given and L is given. So what we are going to do, TP we are putting it aside and AP into L we are going to get TP. So 1 2s are 2, 2 3s are 6, 3 4s are 12, 4 5s are 20, 5 4s are 20, 6 3s are 18. Now what is the formula for MP? TPL minus TPL minus 1. So what we are going to do, this is TP, no, 2 above we don't have anything, so 2. 6 minus 2, 4, 12 minus 6, 6, 20 minus 12, 8, 20 minus 20, 0, 18 minus 20 minus 2. Easily you are going to get 6 marks from this. Okay, after then SMC schedule is there. The question is given here as it is. The question is given here 0, 1, 2, 3, 4, 5 and 6. This is the Q given. SMC is also given in the question. That is 500, 300, 200, 300, 500 and 800. So TFC is also given in the question, which is 100. As it is, we are going to write 100. What and all we need to find? It is given TVC we need to find, TC we need to find, AVC we need to find, SAC we need to find. Okay, TVC. See, TC is equals to sigma SMC. Adding this, we will get TC. But here we have TFC as well. So we know the formula TC is equal to TFC plus TVC. So we have this one, which is 100. So then what do we consider, which is sigma SMC? We consider it as TVC. Okay. So as it is nothing, nil, nil plus 500, 500, 500 plus 300, 800. 800 plus 200, 1000, 1000 plus 300, 1300, 1300 plus 500, 1800, 1800 plus 800, 2600. Now we have TFC. Add this, you will get TVC plus TFC, we will get TC. So 100 plus 0, it's 100. 100 plus 500, 600, 900, 1100, 1400, 1900, 2700. Formula for AVC, TVC divided by Q. So TVC 500 nil minus 0 nil only. 100 minus 1 500. 800 minus 2 400. 1000 minus 3 3.3. Okay. 1300 minus 4 it's 325. 1800 minus 5 360. 2600 minus 6 it is 433. Now SAC TC divided by Q is the formula. TC, here we have 100 divided by 0, 0. 600 divided by 1, 600. And then 900 divided by 2, 450. 1100 divided by 3 is equals to 366.6. 1400 divided by 4, 350. 1900 divided by 5, 380. 2700 divided by 6, 450. So by doing this, easily you're going to get 6 marks. So we are done with the third chapter, 6 marks. Almost all the 6 marks we are done. Third chapter, 6 marks we are done. Now we'll start with the 7th chapter, which is national income. Okay. Suppose the GDP of a country of a particular year is 3000. So GDP of a country, it is given. Okay, it is GDP is equals to of a country is given, which is 3000. Net factor income from abroad is given 500 crore. Depreciation is given 450 crore. Net indirect tax is given 300 crore. Okay, we have to complete this table. So here, before understanding this, you have to keep in 3 points, some tricks you have to follow. Okay, for every gross, you have to turn it into net. What you need to do? So gross, okay, minus depreciation, you will get net. Okay, for every gross you have to minus depreciation. Every gross which you need to turn it into net, you have to minus with depreciation. And every FC you have to turn it into MP. Then with FC you add net indirect tax. Okay, with every MP you have to turn FC. Then what you need to do, take that MP, add net indirect tax, you will get minus indirect tax, you will get anything with FC. After then, if you want to convert your GDP into GNP, then what you need to do, with your GDP you add net factor income from abroad. This trick you have to follow in order to find out the correct answer. See here, the GDP is given, which is 3000. Next, GDP at FC. It means turning MP into FC. What we need to do? Minus net indirect tax. So what we need to do? 3000 minus 300, 2700. NDP-MP. See here, GDP-MP is here. NDP-MP we have to turn, which is gross into net. Then minus depreciation. 3000 minus 450, 2550. And now NDP-MP is there. You have to turn it into FC. So how MP you will turn it into FC? Minus indirect tax. Then you will get this answer. GDP-FC. Now GNP-MP. GDP, turn it into GNP. So add net factor income from abroad. GDP, you're turning into net factor income from abroad. Okay, 3000 plus 500, 3500. Now GNP-MP, you have to turn the MP into GNP-FC. So what you need to do, GNP-MP minus net indirect tax, 3500 minus 300, you are going to get 3200. GNP-MP is here. You have to convert it into NNP-MP, gross into net. So when you're moving from gross to net, then you have to minus depreciation. GNP-MP minus depreciation, you will get the answer. Okay. For every gross, you need to turn into net minus depreciation. Every factor cost, you have to turn it into market price, add net indirect tax. Every market price, you have to turn it into factor cost, then minus net indirect tax. Every GDP, you have to convert it into GNP, then add net factor income from abroad. The same again the question. GDP-MP is given 1000. NFIA is given 1000. Depreciation is given 250. Net indirect tax is given 300. Now it is asking you to find out GDP-MP, which is already given 1000 crore. It is asking you to find out NNP at MP, GNP at MP. After then, it is asking you to find out NNP at MP and NNP at factor cost. See here, NNP at MP. GDP at MP is here. Okay, so you have to find out GDP at MP. First, we'll find out this one. GNP at MP. So what you need to do, GDP to GNP, what you need to do, formula is GDP MP plus net factor income from abroad. So GDP MP is equals to 1000 plus net factor income from abroad is equals to 100. 1000 plus 100 is equals to 1100. Now GNP MP we have find out. Now it is asking you to find out NNP at MP from gross to net. From gross to net means what you need to do, GNP MP minus depreciation. So GNP MP is equals to 1100 minus depreciation is equals to 250. 1100 100 minus 250, 850 is the answer. Now NNP MP into NNP FC. It means you are turning MP into FC. What is the formula to turn MP into FC? Minus indirect tax. NNP at MP minus net indirect tax. 850 minus net indirect tax 300 is equals to 550. Okay. Now rest it is asking you which one is national income. The answer is NNP at FC is national income. Is GNP always greater than national income? Yes, because GNP comes first, after then NNP comes. So GNP will have more value than NNP. What is macroeconomic identity? Macroeconomic identity is GDP, gross domestic product, formula is C plus I plus G plus X minus M. Consumption, investment, government expenditure, export, import. So goods and service produced in a country over a period of time, example 1 year, is called as GDP. What is NDP? Net domestic product. GDP minus depreciation is called as NDP. What is depreciation? The loss in capital value due to daily wear and tear is called as depreciation. What is GNP? Gross national product. The money value of goods and services produced in our country over a period of time, example 1 year, is called as GNP. The formula of GNP is equal to GDP plus net factor income from abroad. NNP, GNP minus depreciation is called as NNP. So there are two types of NNP: NNP at market price, NNP at factor cost. If you need to find out NNP at market price, you need to NNP at factor cost plus net indirect tax. If you need to find out NNP at factor cost, then NNP at market price plus net indirect tax minus net indirect tax. Then NNP at FC is considered as national income. After then personal income. Personal income is national income minus undistributed profit minus transfer payment minus corporate tax plus interest received by household. So everything will be minus, only one thing will be added, which is interest received by household. Okay. PI minus tax and non-tax payment. After then briefly explain the expenditure method of measuring GDP. Expenditure of final is taken into account, not of intermediate. See, expenditure of final goods only is taken into account and intermediate goods is not taken into account. Firm I can make final expenditure. This is the expenditure of one firm, which is consumption expenditure, investment expenditure, government expenditure and export expenditure. If this is only the expenditures of one firm, which is CI plus II plus GI plus XI. Now we are going to take the total of all the firms available in our country, to which sigma ni is equal to 1, revenue of I is equals to, revenue is equal to expenditure, no? So that is why we are taking RVI is equals to sigma ni is equal to 1 CI plus sigma ni is equal to 1 II plus sigma ni is equal to 1 GI plus sigma ni is equal to 1 XI. So this is the total number of firms expenditure of all over the firms available in our country. In this we have to remove import expenditure because that money does not flow in our country, it flow outside. So that is why we have to remove consumption expenditure minus consumption import, investment expenditure minus investment import, government expenditure minus government import. Okay, so we have to remove C minus CM, I minus IM plus D minus GM. So all we have to remove it from export only. So what we will do, we'll keep C plus I plus G aside and plus in the total N, sigma N X into I is equal to I into XI, minus in that we are going to remove all the import. From the export we will be removing all the import in order to balance export and import. CM plus IM plus GM. So that finally we will be getting C plus I plus G plus X minus M. So this is the calculation of GDP under expenditure method. That is total number of firm I is equal to 1, revenue into I is equal to C plus I plus G plus X minus M. Now explain the numerical example to show that all the three methods of estimating GDP. So first is product method, gross value added is equal to sales minus intermediate good. Suppose Mr. A produces cotton and sells to Mr. B for rupees 50 and B made a cloth out of it and he sells it to C for rupees 200. Then you have to find out the product method. So here you see A sales is 50, intermediate goods is 0. So the gross value added is 50. B sale is 200 and the intermediate is 50. Then the gross value added is 150. So the total the total production is the worth of 200 rupee. The total value added is 200 rupee under product method. Expenditure method, C spends 200 rupee to buy the cloth. So the total expenditure is 200. Income method, the calculation of GDP based on the reward of the factor of production. So when A earned 50 rupees, he spent it, distributed it as wages, rupees 20, and rest he took it as a profit of rupees 30. B, when he sold that price, which is 150, in that 60 he paid the wages and rest 90 rupee he took it as his profit. So when you add the wages of both the firm A and B, it is 80, and the profit of both the firm, which is 120, again we are getting the answer, which is 200. Income is distributed in the form of wages and profit, which is also 200. So the conclusion is, it is the numerical example to show that all the three methods we get the same answer. Now let's discuss what are the limitations of GDP as an index to the welfare of a country. It ignores distribution of income. GDP shows total income, but it does not show how it is shared, because rich people will earn more and poor people will remain poor. So GDP rise, but it does not give any assurity of increasing the welfare of the people. Does not include market activity like household work, like cooking, cleaning, caring for children. Though it is a great service which is not counted in GDP, though it it will increase the welfare of the people and society. GDP ignores externality. What is externality? Positive and negative externality. Any benefit done to which not rewarded, any harm done to which not penalized is called as positive and negative externality. That is not included in GDP. The way we polluting, okay, when we are giving education to the poor and unprivileged, the reward and penalty is not recognized. Okay, GDP does not consider any charity or gifts, does not consider quality of life like health, education, life expectancy, etc. It ignores the leisure time, which is very important for all. Okay, we need some relaxation also. We cannot always be only in the production, so it is not taken into account. Does not measure black money, illegal activity, and non-economic activity. It shows average GDP, and it is not the real income of the people. Okay, by this we are done with the 6 marks of national income accounting. Now it is the last 6 marks from money and banking, which I believe it will surely come, and it is very easy for you to answer it. Goldsmith Lala. In older days, people used to keep their gold with a goldsmith Lala for safety. Lala gave them a receipt for gold deposited as an acknowledgement. People started using these receipts for making payments of carrying gold everywhere. Lala observed that not all the people come to withdraw gold at the same time, so he had decided to lend some gold as loan and charge some interest. One day, Ramu asked 25 kg of gold loan. Lala gave him and charged interest. Ramu paid 25 kg of gold to Ali for buying goods and services. Ali deposited with Lala for safety. Now Lala has original 100 kg of gold plus 25 kg of gold. So Lala made gold 100 to 125 out of thin air. So what is the conclusion? With this story, we understand the modern banking system, how the modern bankings are making money out of a thin air. Okay, by this we are done with the 6 marks. So let's understand the 3 model paper practical oriented questions, so that it will be very easy for you, because the model paper questions are getting repeated for the second PUC examinations. So the same we expect for economics also as well. So we are going to understand the practical oriented question. The consumer wants to consume x1 of x1 is equals to 6, x2 is equals to 8, and income is equals to 120. How many x1 can he buy in his entire income? So what you need to do? The answer is income divided by price of the x1. Okay, so what is the income? 120. And what is x1? 6. It means 20. So you have to write 20 x1 can be consumed with his entire income. Okay, next one, B. How many x2 can he buy in his entire income? So y divided by x2, 120 divided by 8, 120 divided by 8, 15. So you have to write 15 x2 can be consumed with his entire income. Okay, slope of budget line downward or upward? So the answer will always be downward. Okay, please write downward, because the slope of budget line is always downward. D1, are the bundles equal to budget line? Yes. If the consumer wants to have x1, x2 has to be given up. Is it true? Yes, it is true. The same method we will follow for the next question. So A1, income 200 divided by 5. So what is the answer? 200 divided by 5, 40. B1, 200 divided by 10, which is 20. C1, downward. D1, yes. E1, true. Again, 300 divided by 15, 20. 300 divided by 10 is equals to 30. C1, downward. D1, yes. E1, true. So this is your model paper. Each questions and answers you have to, you just got the idea how you need to answer. Similarly, let's go with the second POQ. What you need to do, the methods are very same. Okay, what you need to do, go with this. Always vertical line will be the price, horizontal line will always be the quantity demanded and quantity supply. This is always X, this is always Y, this is always price, this is always quantity. Okay, you have to find equilibrium point, equilibrium price, equilibrium quantity, excess demand, excess supply, so that you will get the marks for identifying each of them. Let's go with the prices over here. 1, 2, 3, 4 and 5. It's almost the same. 20, 30, 40, 50 and 60. So 1 is equals to, first we'll find out 1 is equals to 60. 1 is equals to 60. 2 is equals to 50. 3 is equals to 40. 4 is equals to 30. 5 is equals to 20. Okay, so mark a line. Same thing, 1 is equals to 20. 2 is equals to 30. 3 is equals to 40. 4 is equals to 50. 5 is equals to 60. The same thing we will mark it here also. So we need to identify equilibrium price, equilibrium quantity. This is equilibrium point. So equilibrium point you have identified, which is this. Equilibrium price, which is this. Equilibrium quantity, which is this. Now you have to find excess demand. What is excess demand? Here it is, because this is the demand line, this is the supply line. Here you see the supply is less and demand is more. So this is considered as excess demand. Here you see the supply line, supply is more, demand is less. So this is considered as excess supply. So once you identify all of this, you will be easily getting 5 out of 5. Okay, the same thing you have to follow here. Here also the same. Mark line. So this is x-axis, this is y-axis, this is origin. The price 1, 2, 3, 4 and 5. This is price. This is quantity. Okay, which is 5, 10, 15, 20 and 25. For this you will get graph. Okay, as per in the graph you have to mark. 1 is equals to 25, 2 is equals to 20, 3 is equals to 15, 4 is equals to 10, 5 is equals to. So let's mark. So this is your demand curve. What is the demand curve? As the price is less, demand is high. Price is more, demand is less. Supply curve, it is positively 1. When the price is less, supply is less. When the price is more, supply is more. So here you can see 1 is equals to 5, 2 is equals to 10, 3 is equals to 15, 4 is equals to 20, 5 is equals to 25. So this is considered as your supply curve. So this is your equilibrium quantity. This is your equilibrium price. This is E is your equilibrium point. This is your excess supply, always the supply will come here only. Okay, excess supply, and this is your excess demand. The same thing, same diagram again here also. So that what is the purpose that I'm working on all of this is that you should not miss even a single mark. Okay, try to understand. So sorry, the price will always come in the vertical side, 1 2 3 4 and 5. So here it is 15, 20, 25, 30 and 35. 1 is equals to 15, 2 is equals to 20, 23 is equal to 25, 4 is equals to 30, 5 is equals to 5. So this is the supply curve. After then 5 is equals to 15, 4 is equals to 20, 3 is equals to 25, 2 is equals to 30, 1 is equals to 35. So this is your demand curve. So this is your equilibrium point, this is your equilibrium quantity, this is your equilibrium price, this is your excess supply, and this is your excess demand. You have to make sure of writing all of this. If possible, you write it equilibrium price is equals to 3, equilibrium quantity is equals to 25. If you write like this also, it will be good. Okay, you will get a graph for this, so make sure you to work on it neatly. For this you will be getting a graph. Now, very interesting question and very easy question. This model paper, all these 3 questions, if you work out on this, it is very easy for you to answer for this sum. For everything here you should add the remaining, you will get it. For everything here, minus the remaining. If you need to find out this answer, minus the remaining. Okay, for example, here what it is, here we need to get the answer, so we have to subtract from the remaining. So 3500 minus 0. So anyone can do this sum. Okay, zyada dimag, you no need to contribute. Take your calculator, 3000 minus 0, answer will get 3500. Okay, now here we have written as plus sign. So what you need to do, add the remaining 3500 plus 1300, 4800. Here we need to find, then minus a sign, then you have to deduct the rest. What you need to do, 3000 minus 1200, 4800. See, again here we means add. What we need to do, 6000 plus 1000 is equals to 7000. Now rest everything you add it here. 3500 plus 1300 plus 1200 plus 1000. We are getting 7000 as the answer. By filling 1, 2, 3, 4 and 5, filling missing the product, by answering them you will get 5 out of 5. Now what you will do, always plus for this. If you need to find this 2, then you have to add the remaining. If you need to find this missing product, then you have to minus the remaining. If you have to find this missing product, then you have to minus. Only this is the total. So for that we will be adding. Okay, this is all total. Okay, 700 minus 0, 700 only. Here add 700 plus 200, 900. Here 1200 minus 300, 900. Okay, add 1500. Add all of this, you will get your answer. 700 plus 200 plus 600, 1500. Same here also. This minus this minus this plus 1000 minus 0, 1000. 1000 plus 400, 1400. 1900 minus 500, 1400. 1900 plus 600, 2500. All of this you add it now. 11,000, 11,000, 15,001, 2,500. So by this we have done all the POQ. Surely you're going to get 10 marks from this. Thank you so much for watching.